So you say March in place as value catches up to growth here, and then year end, cash out?
Well, if I were to put a picture of what the market's going to look like this year, it's sort of like the Big Dipper, that star formation. You're going to be flattish into August. You'll have a drop down, a consolidation. The Fed's reaction function's just too slow. And then they'll cut rates by year end as the unemployment starts to rise. Then you get a strong Santa Claus type rally in December. And you end up with a sort of a Big Dipper in the back half. And that's how I would picture the index level movements. Within the short term, we do make tactical trades like this equal weighted S&P. RSP is an ETF. I think it'll get back to its February 2nd high. I do like financials, industrials, basic materials, and I would accumulate energy here and energy services. This is just a bear trap pullback since last June. We are not done yet with geopolitical risk and energy.
Barry, your point about yields getting more attractive as inflation recedes makes a lot of sense. But I guess, do you foresee a moment where that just gets boring, given some of the, at least, discussions around AI? I mean, how intense can that FOMO chase get?
AI is interesting and it's exciting, but the problem with all new vast, big technologies is that initially they have a Schumpeter-type disruption event. In other words, they're going to be highly disruptive for the economy, the stock market, and in a sense bearish. But then as they proliferate, they become bullish as the technology is adopted. I do think that's what's likely with AI. We're overestimating the positives and underestimating the negatives that we'll be deriving from that.
You worry about China? I know you like cyclical value because the economy is holding up here, but there were some high expectations for big growth coming from China this year that's not panning out.
Yeah, China's got some balance sheet issues. Remember, they've got the private sector pretty leveraged up. The public sector is actually under leveraged. So what they could do is start to use more fiscal, and I think they're talking about doing that. But when we analyze in detail the Chinese stimulus as a percent of Chinese GDP and do what's called a second derivative or an impulse, they have done enough already to more or less put a floor under the global PMI for manufacturing. I think it's going to be 50 very soon. And as a consequence, into the summer months, the U.S. PMI manufacturing could pop up. And when that occurs, you get your cyclical value trade. But as I said, at some point, good news is bad news. The Fed is still out there. And if inflation doesn't fall adequately, they're going to stay tight.